The broadcast is now starting. All attendees are in listen-only mode.
Hi, everyone. We'll be starting the webinar in just a couple minutes. Today's webinar is called What Are Transaction Costs and How Do They Impact Your Algorithm's Performance? We're just waiting for the last attendees to sign on. Hey, everyone. Just a reminder that we're waiting for all of the attendees to sign on, so we'll start shortly after 11. Hi, everyone. Welcome to today's webinar, What Are Transaction Costs and How Do They Impact Your Algorithm's Performance? As always, this webinar is being recorded and will be made available on our website and on YouTube in the next few days. Please remember that there will be a Q&A session at the end of the webinar, so if you have a question, you can ask Michelle by typing it into the box on your control panel. Dr. Michele Goe is a quantitative trader at Quantopian. Prior to joining the firm in 2017, Michelle held a postdoctoral research role at the Rochester Institute of Technology for 2 years. While there, she developed geospatially explicit nonlinear optimization models, which were utilized to estimate the environmental and human health impacts of renewable energy adoption scenarios. Michelle has worked as an engineer for leading design and manufacturing consumer product teams such as at Bose, Apple, and at General Motors. Dr. Goe has earned her doctorate in sustainability from the Rochester Institute of Technology, a master's in manufacturing engineering, and a bachelor's of science in mechanical engineering from the University of Michigan. Thanks, Michelle.
Thank you, Paige. So I'm going to navigate from the Quantopian homepage to my notebook. And show the disclaimer so you all understand that we're not providing investment advice. This is for educational purposes only. The title of this webinar is What are transaction costs and how do they impact algorithm performance? In this webinar, we will explore the attributes of an order that influence transaction costs based on published market impact model research and our own Quantopian trading team's experience gained from executing and analyzing Quantopian's trade data. In addition, we explore the impact of turnover rate, transaction costs, and leverage on your strategy performance. And finally, we become familiar with how Quantopian trading team thinks about and measures transaction costs. Transaction costs have two flavors. Direct, which are commissions and fees from the exchange, regulatory fees, and some ticket charges, depending on your brokerage agreement. These are easily measured, and in institutional trading, they're relatively small. So we won't discuss them in our webinar. Our focus in the webinar today are indirect costs, which include market impact and spread costs. Now, transaction costs are measured at the order level. Therefore, when we speak about order attributes, we speak about order attributes when discussing factors that influence your transaction costs. And we'll talk about volatility, liquidity, relative order size, and the bid-ask spread. Now, although market impact is measured at the order level and assessed at the algo level, we can take a 3,000-foot view of market impact to understand the influence on an algo or a portfolio's performance. So let's consider a hypothetical mid-frequency statistical arbitrage book. The attributes of this algo in this portfolio are that the holding period is a week, it's twice levered on 100 million assets under management, and we'll assume it trades 252 days a year. If we're trading 252 days a year and our holding period is a week, that's 5 trading days. We're trading in and out of a new portfolio roughly 50 times a year. So in that 5 trading days, we trade our 100 million AUM twice, 2 times levered 50 times. That means we're trading $20 billion a year. For this level of churn, the question we want to ask is, what is the impact of 1 basis point of execution costs to the fund's returns? And again, we're discussing implicit costs, which are market impact, slippage, and not commissions or fees. So how do we determine the impact to an algo's performance of this 1 basis point cost? We take the product of the leverage, turnover, trading days, and the transaction costs and basis points scaled. Our turnover is 40% of the AUM is traded per day. So for every basis point of transaction costs, we lose 2% off of our algo's performance. So as we shrink this cost, we shrink the performance hurdle algos need to overcome. So this is linearly increasing. So that means every time we increase our basis point costs, say if we go from 1 to 10, then our hit of our algo performance goes from 2% to 20%. So just to give you an idea of how large this burden can be, the HFRS index, which is a hedge fund market neutral US equity index, is roughly flat on average over a year. It's about 1.2% returns. So for the average asset manager, there's little tolerance for high transaction costs. So understanding your costs is important to help you understand how feasible your strategy is in terms of real life trading. So now let's talk about how you would measure these costs. So Quantopian trading team thinks about and evaluates transaction costs in a very methodical way. So we use our execution tactics that aim to complete all of our orders fully. An execution tactic is a set of algos provided by the broker that specifies how an order will be executed in the market. And it details the participation rate, the order completion time, which venues to participate in, the overall aggressiveness of our trading, which can also dictate the amount of spread that we're willing to pay. The goal of our execution tactic is to minimize the costs of executing in the market while completing our parent order fully. So how do we achieve this goal? The parent orders are split into child orders routed to different venues with the goal to capture liquidity and minimize the bid-ask spread. And then the parent level execution price is expressed as a volume weighted price of all the child orders. So this execution price is what we need to compare to a benchmark in order to have a metric for how to tell how well are we trading. What is our basis point cost? So we'll use different benchmarks depending on what we want to look at. If we want to look at and compare our decision price or the price executed in the market, we'll use arrival price, which is what we define as a decision price, the algo. And the algo, when your strategy decides when it's going to trade, that's the price we take as a decision price. And it's the mid quote at the time that the order is placed. We could also look at the interval VWAP. So the life of the order is defined as the period from the first fill to the last fill. And so that's the entire life of an order. And that interval, we're not the only person trading a security. There are other participants in the market. And in order to compare our execution price to those other participants, we'll use interval VWAP to understand how much our cost was in comparison. There are other benchmarks that tell us about reversion and momentum. So the reversion metrics give us an indication of our temporary impact after the order's been executed. So it could be T plus 10 minutes, which is 10 minutes after our last fill, or T plus 30 minutes, which is 30 minutes after our last fill. And generally, we expect the stock price to revert a bit or go back to the price near our arrival upon our order completion, as our contribution to the buy-sell imbalance is reflected in the market. Close is another benchmark we might strike for reversion. Then there's momentum metrics or benchmarks. So momentum is giving us an indication of price drift. So the price is moving prior to us placing our order in the market, and we want to understand how is the price moving. And if we have significant momentum or price drift, it will affect our ability to minimize the bid-ask spread. So we have the open as a benchmark for momentum, and then we might also look at the previous close as a benchmark to compare it to our execution price. So the key idea here is that commonly what you'll see when referred to as slippage or implementation shortfall is our metric of cost versus arrival mid price. So what's interesting about trading in the market is that there are trade-offs to consider when you want to figure out how long you want to trade in the market. There's some risk. There's two risks in particular I want to discuss, which are timing risks and market impact risks. So the timing risk talks more about the price drift as we increase the interval over which we want to trade. And so if you look at the graph, conceptually, it shows as we increase our order interval, the time between the first fill and the last fill, we're leaking more information to the market participants. We're telling them we're ordering whatever direction that we're ordering, and they can see, say if we have 100 shares to execute and we're executing one share at a time really slowly, we're leaking our information to the market and they understand what we're doing. There's another trade-off here, which is maybe we could execute slower so we won't give as much information to the market about what we're doing, but then we have a risk of trading too aggressively and moving the market too fast, which means we'll incur higher costs when our order interval is too short because we're moving the market too fast by trading too quickly. And so the idea is we want to balance a market impact and timing risk and meet somewhere at the intersection of these two curves so that our transaction cost has an equal contribution between market impact and timing risk. So let's explore the attributes of an order that influence our market impact. So again, they were liquidity, relative order size, volatility, and the spread. So let's start with the liquidity. So liquidity refers to access to volume in trading, and it's an indication that of participants on the other side of your trade. One way to assess liquidity is to look at the intraday volume curves, both in absolute terms and as a function of 20-day volume or the percent of volume of our trading. We can also look at the cumulative intraday volume and a relative order size. What we expect to see in terms of the intraday volatility patterns is liquidity is highest at the close and the second highest at the open. And midday is a very low liquidity. So in general, I have a note here that liquidity should be viewed relative to your order size of the same securities in your sector and your class. So let's look at the volume curves for a random stock. Here I picked Facebook, and we're taking minutely volume for a 6-month period in 2016. And we're going to plot the intraday volume profile and the percent of volume. Oh, intraday. And so we see there's a lot of activity in towards the open and also the close. And of course, you all know that Quantopian's volume and price data, the last bar is at 4 p.m., which means it doesn't include the closing auction, which has even more volume than the 4-minute bar. And so this there would be another point that would spike a bit higher. So here we see the most volume in the beginning and the end of the day, and the percent of volumes over the day are high in the open and into the close. And so this is just for one day, random day in 2016. Is this a trend for our 6-month interval? To find that out, we can make a time series scatter plot of the percent of daily volume. From 0 is 9:31, so it's the time from the open all the way to the close. And we see the same trend of the highest percent of the day's volume is at the open. It's a lower percent of day's volume in the midday, and then it climbs higher at the end of the day. And if we had a bar for the closing auction, it would be even higher than data points for the closing auction. It would be even higher than the 4 p.m. bar. So if we take the median of this curve and do a cumulative distribution, that's also interesting to look at. And it validates the same pattern that we discussed before. So if we're looking for liquidity, we would trade at the open or at the close. So depending on our order size, it will determine how much liquidity is required. So let's talk about relative order size and also how that impacts the time that it takes to fill our order. So depending on what percent of volume we are of the day's volume, at a specified participation rate, we expect as our relative order size increases, the time to complete our order increases. So for a VWAP strategy, a scheduling strategy, a 3% participation rate, we would be 3% of each, for example, minute bars volume. And so we would take the entire day to trade if we're 3% of the day's volume, because we're taking 3% of each minute bar's volume. So VWAP is a scheduling strategy. It's a pre-specified time window. If we expect to have very high relative order sizes, we might want to switch to a liquidity management execution strategy when trading so that we ensure that we complete by the end of the day. So in this scenario of a 3% participation rate at 3% of the day's volume, we would complete by the end of the day. But if we want to have a higher relative order size that's higher than 3% of the average daily volume, we might need to switch our execution strategy so that we can, say, specify more urgency or executing in other venues, or a willingness to be more aggressive in terms of capturing the spread. So my example here shows, again with Facebook, we take this a day in 2017 and calculate the average daily volume, the 20-day average daily volume, and our order size is some percent of this average daily volume, and we want to find the fill time for our participation rate that's specified. So how long is it going to take us to fill this order? And we're going to create a plot for a set of participation rates and a set of average daily volumes. And look at the relationship between the average daily volume, the time of the order, and then each line represents a different participation rate. So on the first blue line, we're participating 1%. So 1% of, for example, each minute bar in the day. So we would expect that if we're 1% of the day's volume, it would roughly take us the entire day to complete that trade. As we go from the blue to the green to the red curves, we're increasing our participation in the market, and so we're able to trade at a faster rate for the same given average daily volume. Another thing to notice on the first blue curve is at 1% participation rate, as our if we go back into a lower average daily volume, it takes us less time to trade, right? So this says nothing about transaction costs, but just tells us how long it would take us to trade. And if you remember our timing and market risk intersection curves, if we're a very high percent of the average daily volume and we're at lower participation rate, it's going to take us longer to trade, and we're going to have a higher timing risk, so a higher risk that the price will drift away from us. Conversely, if we have a higher participation rate, we'll trade more aggressively and have a higher market risk, higher risk of moving the price. Another order attribute that influences transaction costs is volatility. So volatility is a statistical measure of dispersion of returns. So the higher the volatility, the more uncertainty in the returns, and it's an artifact of larger bid-ask spreads during the price discovery process at the start of the day. So what's interesting about volatility is it peaks at the open and then decreases, whereas liquidity is highest at the open and at the close. And so if we want to take advantage of low volatility, we would trade at the close. If we want to take advantage of high liquidity, we would trade at the open. And so there's some trade-offs to choosing a trading time at the end of the day or at the beginning of the day. So I demonstrated here two different ways to calculate volatility. You can use the open, high, low, close method, or the most common close-to-close method. And both are detailed in this paper that's referenced below. So the information we need to pull is the open, high, low, and close prices for each minute for the Facebook. This is the security that we've chosen. And I've coded the equations here for close to close and open, high, low, close. I added a couple columns so that we have the minute of the day and the time. And I needed to shift the close value down one row to do the calculation. And I take the log of the close to close and the daily mean of the log of the close to close. And all of this is leading to getting the daily variance and coming up with a pretty cool scatter plot that shows us the percent of the day's volatility on the y-axis, and on the x-axis the time from the open. So 0 is 9:31, and so we have 10-minute intervals on a time series scatter plot. So again, we see the same trend, a higher volatility at the open, and it drops after the open. And this is a median of the scatter plot values for 10-minute intervals and a cumulative distribution of the volatility. So the last order attribute we will explore before looking at market impact models is the bid-ask spread. So the spread refers to the difference between the best bid and the best ask. And we've done some analysis on our trade data looking at the order attributes of our trades and how we can predict the spread based on these order attributes. So from each order, if we have a market cap, a volatility, average daily dollar volume, the price, and the time of day, we have observed some relationships between this and the bid-ask spread. For example, the market cap increases as we expect spreads to decrease because larger companies tend to exhibit lower bid-ask spreads. As volatility increases, we expect spreads to increase because of greater price uncertainty. As average daily dollar volume increases, spreads decrease because liquidity tends to be inversely proportional to spreads. Price is similar to market cap. So as price increases, spreads decrease, and as time of day progresses, we expect spreads to decrease because we have price discovery, higher volatility in the beginning of the day, and a priority at the end of the day for order completion, which where spreads are smaller. So this is a log linear model that we developed to predict the spread of a security, and I have a sample calc here given some order attributes. So now that we have explored how the attributes of an order impact transaction costs, we can put all of the knowledge together in an aggregated model that will take any trade and estimate its transaction costs. So we're going to discuss several different models. There's a lot of published models out there, so these are not particularly notable. They're just interesting because they have different formulations and some commonalities and some differences. So the commonalities between the models that I've chosen here is that they all include relative order size and volatility, and they all include some custom parameters that are calculated from observed trade data. So that means they have hundreds of thousands or more of live trades that they've done and fitted their parameters of their model to these live trades to validate their model and the functional forms of their model. There's some notable differences between these models. So the JP Morgan model explicitly calls out the spread impact, where some of the other models don't include spread impact explicitly. And the Aam Grim model considers a fraction of outstanding shares traded daily. Our Quantopian slippage model does not consider volatility. And there's a Kissel model where it has an explicit parameter to proportion temporary and permanent impact. So the academic models have these notions of temporary and permanent impact. And what they mean by that is temporary impact is capturing the impact of transaction costs due to the urgency and aggressiveness of the trade, whereas permanent impact estimates with respect to information or short-term alpha in the trade. So the first model we'll look at is the Aam Grim Model. So it has a permanent and temporary impact in its functional form. It includes volatility. It has a percent of outstanding shares, which can be interpreted as the fraction of the company's value that's traded each day. And it has included in the average daily volume, so the percent of your relative order size. Some potential limitations that I need to point out for these models is that because they were released prior to the adoption of Reg NMS and the financial crisis, there have been developments in the market microstructure. That means these models are estimating market impact, and so they may under or overestimate. So they're limited. They have limitations in modeling the different market microstructure that's formed since these events, Reg NMS and the financial crisis. So we break up the Aam Grim model to permanent and temporary impact and then combine them. They have their parameters, and what's interesting to note here is as we increase our participation rate, so we can trade aggressively, very fast, or medium, or slowly, we see that if we trade quickly, we have a higher transaction cost than if we trade slowly. So this depends on the percent of the days or relative order size that we're going to trade. And in this case, the permanent impact is the same, but the temporary impact, which is influenced by the relative order size, is changing our transaction cost. So in the Aam Grim model, as we trade a higher percent of the average daily volume, we have a higher transaction cost. And if we have a higher volatility, we'll also have a higher transaction cost, right? So this is expected. Some other interesting results from this model is as we trade higher ADV, we can see these contour plots. Each line is a cost budget. And so for the same cost budget, say if we wanted to keep our cost below 10 basis points, so we would follow this purple line and say, okay, if we have 0.5% of ADV to trade, how long should we take to trade that? We should take 17 or 18 minutes or more to trade that, because if we trade faster, we'll incur a higher transaction cost. So each of these lines are some kind of transaction cost budget that basically indicates as we trade a higher ADV, we need to trade slower to stay on our same cost budget. And these two graphs contrast different volatility. So if we have a lower volatility for the same range of ADV, our cost budgets are a lot lower. So we'll basically incur a smaller transaction cost if we have a lower volatility. So these contour plots tell us the similar story. So we have trade as a percent of ADV on the x-axis, on the y-axis a basis point of trade value, and then our colors are telling us the time in minutes to trade. So as and each plot gives us the same contour with different values for different volatilities. So looking at the right graph, if we are at 1.5% of the day's volume, what is our transaction cost going to be if we want to trade faster or slower. If we trade slower, we're in the red, we'll have a lower transaction cost. If we trade faster, we move towards the yellow, greens, and then the blues, and we'll have a higher transaction cost. And so we have the ability to trade. We can trade slower for the same ADV if our volatility is lower. Okay, I'm going to skip the proportion of permanent and temporary and go into the JP Morgan model. So JP Morgan uses an explicit spread cost parameter. So it's basically breaking out the spread separate from the relative order size and the volatility. So here our spread model would be helpful to predict based on our order attributes what the spread would be and add that to our market impact model. They have parameters fitted based on their live trades. The volume share slippage model of Quantopian uses relative order size. And so there's no volatility here and no mention of spread of the spread, no parameter for the spread. So what we can do is we can compare these models together and just look at their for a fixed time trading time as a percent of ADV, how are their predictions and transaction costs vary. So it's interesting to note that at, say, 0.4% ADV, the Quantopian volume share model and the JP Morgan model largely agree, but Aam Grim has a higher estimate. And most of the models are close together with lower ADVs, and then as the percent of the daily volume goes up, they tend to diverge a bit. So general insights or conclusions that I'd like you to take away from this talk is to think about how when you build a strategy and you have some performance that you're expecting your strategy, transaction costs are going to eat away at that. And so paying attention to things like your relative order size, the liquidity of your names, the volatility or time of day you trade is going to impact how much the transaction costs eat into your performance. And so here's some guidelines for thinking about and evaluating your strategy to understand how your transaction costs impact your algo performance. I hope that you've found this webinar helpful and insightful, and at this point we're going to take some questions from the audience.
Yep, we're going to move into the Q&A portion of the webinar now. So if you have a question you want to ask Michele, put it into the text box on your control panel and she will get to it if we have time.
So the first question is, do you think momentum-based strategies are effective, or are they ineffective due to high turnover or transaction costs? Thank you for the question. So from the trading team's perspective, we don't necessarily have a view on whether one can build a profitable momentum strategy. We do, however, believe that such strategies tend to be trickier to implement from the transaction cost perspective and require a lot of care when modeling and backtesting. The second question is, why are you using the midpoint price as a starting price benchmark? Should you be using the offer price for a buy transaction and the bid price for a selling transaction? Thank you for your question. It's a good question. So we have adopted commonly used industry benchmarks when it comes to arrival price estimates. Industry professionals tend to use mid price because it is the closest approximation to a fair value of a security at the time an investment decision is made. The next question is, what makes those volatility formulas look different from the formula for sample variance that one would see in a basic stats class? So thank you for your question. We shared with you one of many volatility models out there. One obvious benefit of this model is that it incorporates intraday price, so the open, high, low, and close, rather than just closing prices. Another question is there any white paper reference for the Quantopian model mentioned? We don't currently have our own white paper on this topic, but we hope to engage the dialogue with our community about transaction cost modeling by starting with this webinar.
Okay, so I guess we're going to wrap up here. Like I said, this webinar was recorded, so we will share it with you like we always do via email once we get it up on YouTube. We'll also include information about our upcoming webinar schedule. I want to thank everyone for joining. If you have a question that you didn't get to ask Michele, feel free to email it to us at events@quantopian.com, and we might be able to get an answer for you. And thanks, Michele, for a great presentation.
Thank you. Thank you guys for joining us.